Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the Deal Quest podcast. Let's get started. Hey folks, Kupfer here, the Deal Quest podcast. And for those of you who are watching this on video on our YouTube channel, for those of you who don't know, we started doing the podcast has been audio for 120 plus episodes. But the last 10 or 15, we've also started doing video. So check it out on the YouTube channel. If you're watching it on the YouTube channel, you'll notice my background is different. We moved to a new place in our California place. We are building out the studio here like we had in our other place, but it's not done yet. So I am in my home office here with not all my cool sound dampening and whatever, but I think the audio quality is going to be okay. And, you can check out my my background here and check out my home office. So what are we talking about today? Well, the last solo cast I did was on capital gains on the issue or the eventuality that potentially capital gains is going to go up. At least that's what the current Biden administration is proposing. Whether that will pass or not is a big question mark. But we talked about the implications of that for deals. So if you haven't listened to that solo cast, you may want to go back. It actually was, I believe, by far, in fact, I know by far, by multiples, my most popular solo cast, in fact, my most popular podcast episode. So everybody's obviously, it's a hot topic. So I wanted to actually do a follow-up. So this is Capital Gains 2, maybe a deeper dive. And I want to really drill down, into, because there, the last solo cast, I really just talked much more about the landscape and history and how the fact that there are generally a lot of other factors that impact deal flow. It's not just capital gains rate, right? So, and things like that. And also, mentioned that there are people who are accelerating their deals. But what I want to get a little more into here is to delve a little more into what types of deals are there capital gains rates potentially for. And some of them are obvious. There are some that are a little less obvious. There's a particular type of deal that we do called a personal goodwill sale that a lot of people aren't familiar with, which I'm going to talk about. And we're going to drill down a little bit, and also tie it into the current situation as well. So it's sort of, a deeper dive, a take two on capital gains impact on deals. So a few things. So number one, to reiterate a couple of things, what do we see? Well, we definitely saw, as I mentioned, I think on the last Solocast, a lot of folks rushing to get deals done at the end of last year, 2020. And we had a very, very busy November, December on deals closing, just in case rates went up this year. That was, folks who have been super conservative. And frankly, listen, those were folks who were getting deals done anyway. And why not make sure they close in December as opposed to in January, just in case. Now, most of us felt, and it's turned out to be true, that it was very unlikely that there'd be a passing of capital gains increase that affected 2021 because, of course, the new administration didn't take over until January. And then, they would have to, get it passed and all that kind of stuff. And then usually they didn't want these things to be applied retroactively because people have done planning based upon what is so. So that's turned out to be, likely the case. So there is a possibility, however, now that deals, the capital gains rates could go up effective 2022. Again, big question mark, right? Split in Congress, more conservative Democrats probably, may have some issues with it. Democrats might not be able to get Republican votes. I'm not in the politics of it, but the likelihood of it does affect business decisions. So we again this year have folks who are saying, I want to get a deal done this year. Now, again, most of those folks, or pretty much actually all those folks, are folks who want to do a deal anyway. It's not like the tax should drive the business decision. It's not like, oh, we have a great business, we're going to run it for 10 years or even 5 more years, but capital gains rates are going to go up, but now I'm going to sell it, right? There's so many other reasons why we run businesses. It's our calling, it's what we do, how we want to serve clients. It makes us money now in terms of cash flow, and yes, maybe, eventually when we sell it. So, how do you make a decision on whether you're going to let this affect you? Well, listen, if you're planning on doing a deal in the foreseeable future, in the next year, maybe even 18 months, well, you might want to look on, whether you're going to accelerate that. If you're years out, you know what, don't let it drive your decision. Now, what kind of deals are we talking about, right? I think most people understand that capital gains rates apply to, for example, a sale of a business. You own an entity, you own a business, and whether you sell that, the assets of that business, which, by the way, is how most deals are done. If you know anything about deals, probably, I don't know the real statistic, but in my experience, 95 is probably even low. 97, 8% of the deals we do are asset sales, asset purchase deals, because the buyer does not take on the liabilities of the seller for the most part. There are some exceptions. It's not legal advice. It's a podcast, right? I am a lawyer, not your lawyer. That's always a disclaimer. But the point is that that if you're selling the assets of the company, whether it's the entire assets or even a portion of them, there's capital gains rates generally on that. If you're selling the equity, right, stock, membership interest in LLC, partnership interest, whatever it is, there's generally capital gains rates on that. Depending upon what your tax basis is, based upon what you either paid for it, or if you started the company and you didn't have any basis to start with, what basis you've gained over time, by, through retained earnings or whatever it is, right? Again, speak to your tax advisor. Any gain above that tax basis you have is taxed at capital gains rates, which are significantly lower currently than the top ordinary income rates, right? It could be a difference between paying 20% capital gains and, 37.5%? I forget, we used to be 39 something. Now it's like the last Trump change, I think, cut the top rate at federal to 36, 37. Plus, of course, you have state capital gains rates too, depending on what state you're in. The rates, may be different, and there may be a couple of states that don't tax capital gains. So it's a significant difference. So that traditionally sale of a business, sale of assets of a business, sale of real estate, for example, any kind of hard asset sale, right? Now, so if you're selling a business, you're selling equipment, you're selling anything that's at a gain, it's applicable. Now, I mentioned earlier, I'm going to talk about something that a lot of people aren't aware of, where you can do this personal goodwill sale. So let me explain what it is. I'm going to tell you that the IRS is that it's allowed under regulations, but they look at it very, very closely. So you got to do it right. So what is personal goodwill? Let's say you are an employee at a company. Most people think, but you have a book of business, so to speak, right? You're a service provider. It comes up a lot for us with financial advisors, with investment advisors, people who manage money. So they may work for a UBS or Merrill Lynch or Morgan Stanley or Goldman Sachs or whoever it is, right? Or maybe they're employed at a independent broker dealer, right? The LPLs and the Ameriprises and Raymond James, or they have even an independent RA firm, but they're not the owner. The point is, this is the key point. They are not the owner of the business. They are an employee of the business. So in that case, most people think that employees have nothing to sell, or at least nothing to sell that qualifies for capital gains, right? But if you have a client list, right, a book of business, right, and this can apply, by the way, to insurance people, to accountants, to lawyers in the places where nowadays you can sell legal practices you never used to be able to, and you're not the owner of an entity. Most people think, or a lot of people think, I don't get capital gains on that. Maybe I can do some sort of revenue share over time. And in fact, I had this recently, with a buddy of mine in the wealth management field who works at it was affiliated with an independent broker dealer. And the way a lot of those deals are done, when if something happens to somebody and somebody takes over their practice, is that they do it on a rev share basis. But the thing is, on a rev share basis, that's most of the time the way that's structured. It's ordinary income to the seller, or it's not even a sale in that case. It's just a rev share. So if you are the advisor, or again, any service professional who is deceased or becomes permanently disabled, or maybe retires, whatever the triggers are for your book of business to transfer to somebody else, well, a lot of people do it as a rev share, and then it's ordinary, whatever money you get as ordinary income to you, which is not the best tax treatment right now. And on the flip side, though, the buyer or the person who's taking over your book in a rev share, it's not really a buyer, but they're taking over your book, they get a tax deduction for the payments they're paying you, which is good for them. But from the transferor seller point of view, it's not as good. In a situation where you have relationships, okay? And this is the key point. It's not just you're an employee yet. If you can show that you are able to control this book of business, the clients rely upon you. If you left, they would come with you, or the far majority would come with you. So even though you don't own legally the client relationships, right? They have contracts with the company you work for. They're not going to stay with that company because it's a personal relationship business. You have built up personal goodwill. What do we mean by that, right? In a lot of companies, a lot of their value on the company level is a goodwill, because they don't have a lot of hard assets, especially in service professions, right? The goodwill is their client list, right? Their reputation, things like that, right? That's company goodwill. But if you're the one with the client relationship, if people look at you as their person, and they would leave that company to come with you because they're really there for you, then you have built up personal goodwill. And that is a transferable asset subject to capital gains rate if you do it right. And there's some tax, nuances and language that has to be in agreements. But in this example, instead of my friend, instead of doing a revenue share, we said, let's do it as a transfer of personal goodwill, so that if and when it gets triggered, your estate get capital gains treatment on that money that comes in. Okay. So what is subject to capital gains is a broader range than a lot of people think, because of this personal goodwill situation. Well, right now, that makes a difference. If the tax law changes, and if they raise capital gains rates to be equal with ordinary income rates, and again, listen, maybe there's a compromise. Maybe it turns out capital gains rates are going to be somewhere in between. There's still an advantage of having capital gains treatment. But if the proposal goes through and gets approved, and capital gains are treated the same as ordinary income, then all this will not matter, whether you did a rev share or an asset sale, personal goodwill sale. Right now, it still does. So if you're going to do a deal in 2021 and maybe beyond, if nothing changes, or if there's still some difference in capital gains versus ordinary income rates, these are important things to know. And whether you're selling any kind of asset, or whether it's personal goodwill, whether it's hard assets, whether it's you're the owner of the company and you're selling all the assets of the company, which again may be mostly corporate goodwill, right? The client relations, et cetera. You can, no matter how those deals are structured, right? Because sometimes there's money up front, some on the back end, there's earn-out provisions. Those may play into some of the tax analysis, but at a fundamental level, if you are able to sell an asset, including personal goodwill, you'll currently have this favorable tax treatment.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment, and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
Let's talk about some other factors, however, that impact the decision on whether to sell. And, that I alluded to this in the last podcast, but I want to delve into it a little more on how, for example, the 90s was when capital gains rates were a lot higher than they are now. In fact, they were even above what the Biden administration is proposing to up the capital gains rates back to. There were a lot of deals going on. And why was that? So it's just an example. Well, what are the factors that affect deals? Well, one is access to capital, right? And there's a huge amount of capital out there now. Will capital dry up because capital gains rates go up? Not necessarily. I mean, there are a lot of other reasons to do deals. I mean, listen, if you can invest, what venture capital investors and private equity investors do is they invest at X and they want to get multiples of X. And it's usually not 2-3 times, right? Those are the deals that just do okay. And then there's the bunch that don't do well. But they're looking for the ones that are going to, turn 10, 15, 20, in a multiple, depending on what industry you're in, right? Whether it's a big tech play or even, we have a lot of private equity coming into financial services these days, investment advisory firms, fintech, that kind of stuff, right? They're looking for huge multiple returns. So if they are in an environment where they still think they can get those kind of returns, sure, is the net amount that they get after tax going to be lower? But if you can invest $1 million and get back $15 million, right? And that $15 million is now going to be taxed at a 39% rate instead of a 20% rate. Sure, it's not as good, but you're still netting, right? On your on your $14 million gain, right? You're still netting 60% of that, which is the $9 million profit, as opposed to 80% of that, which is a $12 million profit, right? That's still a deal that makes sense to do. So as long as the economy is strong, business is strong, and people think that they can get multiples on their returns, not that the difference in capital gains rates and the impact on their returns, because they do projections and that helps, that influences their investment decision. But at certain of those multiples, they're going to still do the deals anyway. The other, point of it is that if you are the business owner and, at some point you're looking at selling your business, there are a lot of reasons people sell a business. Time of life, you want to retire, right? You want to move on to a new business. You're tired of it. You have a health issue. You need to raise capital to expand, which is a sale of part of the business. All of those factors don't go away. People aren't going to run businesses forever just because capital gains rates are higher, right? In some industries, like real estate, and it doesn't only apply to real estate, it can apply to other types of assets. It may encourage more like-kind exchanges. They call them 1031 exchanges, which is a reference to a tax code section. And people in real estate are more familiar with this, where if you buy so let's say you own a multifamily residential building, and then you sell it at a gain, as opposed to paying tax on that gain now, if within a certain period of time, and there's all kinds of things you got to follow, so I'm not detailing every step of this, look into it. But if with a very short period of time, you roll that into another like-kind investment. So in my example, you own a multifamily residential building, you roll that, and let's say you bought it for $5 million and now you sold it for $10 million, right? Okay, if you roll that $10 million into another multifamily residential building, or there may be other kinds of real estate that are still considered like kind, all right, then you defer the gain on that. You don't have to pay capital gains. So there are ways around having to pay capital gains, by the way, that exist now, but may become more popular as rates go up, to defer those capital gains just to get the time value of money, or maybe to make a bet that at some point, the winds change and capital gains rates come down again, right? So there are more creative ways that may come into play if capital gains rates go up that will also help facilitate deals getting done, like 1031, like-kind exchanges, which again, used mostly for real estate, but don't have to be. There are other kinds of assets that you can sell at a profit and then buy a similar asset class and still defer the gain on it. So I think, if rates go up, it will encourage that. Also may encourage how deals are structured, for example, to play things, over time, because if the, or maybe even go the other way, require more money up front because the buyer is, not getting as much cash total, so maybe they want to get more up front. But whether that's possible also depends upon the market circumstances. So Should we panic? No, I think I made that clear on the last podcast. Plenty of deals have been done with capital gains at various rates. Should we take it into our planning? Yes, but again, it shouldn't be the main driver. And then keep in mind that there are capital gains opportunities in different areas that you may be less familiar with, this personal goodwill one being a particular area. Listen, always you should get great legal and tax and accounting advice. This personal goodwill area is tricky. You don't want to get the IRS to reject it at some point on an audit. You want to make sure you do that right. So definitely get your advice there if you're thinking about doing that. So I'm trying to think if there's anything else. Listen, if anybody has any questions at any point, right, on how you structure these deals, on capital gains, on whether you should be potentially doing a deal before capital gains rates go up, definitely reach out to us. We're doing a lot of this stuff in cross industries. I mean, boy, we've done deals. I mean, we have this focus in financial services. We're doing a lot these days, investment advisory, but we do a lot in tech still. We've done restaurant deals. We've done licensing deals. We've done building and cleaning and maintenance company deals, vitamin companies. I mean, you name an industry, we've probably done it. The ophthalmologies, roll-ups, financial services, tech. We've done some manufacturing even, and I say even because we operate out of big cities generally, but we have clients all over the country, and they're on all different businesses. So wherever you are, whatever you need, if you have any questions on this, we do a lot of these whiteboarding sessions to help folks structure. If you're on the acquiring side, for example, and you want to put a program together to acquire. In fact, I got 2 of these coming up. I got one coming up in next week in California, and then one in New York with clients in the financial services space who are looking to do multiple deals to acquire. And we are doing a whiteboarding session where we go through with them why and who they're targeting and what their value proposition is, and then what the model we're creating around that is, and then what the deal structure is within that model, and what the documents look like, and how they integrate the deal and all that kind of stuff. So we do a lot of this. Happy to talk to you about it. Smart to really take into account what might happen with capital gains, but not to panic. It's never good to panic in business. Never good to have tax policy be the 100% driver, but it should be a factor, as I've said before. And happy to take any of your questions or comments at any point. So, folks, until next week, when we will have a guest interview, and then a few weeks later we'll have the next solo cast. I look forward to hearing from you and seeing you on social media. Thanks for listening. Corey Kupfer, I'm out.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.